Welcome. The material we're looking at today covers Citigroup and Morgan Stanley getting into gold vaults in London. Big move.
Yeah, big move, and really aiming to challenge JPMorgan's spot there, especially with gold prices going up and all that investor interest.
Right. Okay, let's dive straight in. Strength-wise, this piece is absolutely firing on all cylinders from the get-go. You nail the stakes immediately.
Uh-huh.
Highlighting the size over $1 trillion in gold in London and that 50% price jump since early 25. Huge incentive.
Definitely sets the stage.
Stakes game, this competition. And that's actually where our first point needs to focus. You've set up this great dynamic, this tension. Citi and Morgan Stanley presented as, the challengers, trying to knock JP Morgan off its perch as the dominant position, the largest player. It feels like a proper fight brewing.
Yeah, that challenge narrative is really strong. It grabs you. But we need to kind of square that with what the wider industry seems to be saying, just to deepen the analysis of what this market shift really means.
Okay.
Well, the weakness, I think, is that this really compelling tension you build up, it gets undercut almost straight away.
How so?
You bring in people like Ruth Crowell and Paul Fisher from the LBMA, right? And they basically say, hold on, this isn't a zero-sum game. They're saying it'll just make the whole market bigger.
Ah, okay, I see the conflict.
Yeah, and when you put that statement right next to the whole challenger versus incumbent setup, it kind of accidentally lets the air out of the tires. It feels like, okay, massive rivalry. Oh, but actually, it's fine, everyone wins. It reduces the drama.
Yeah, that does flatten it a bit. So what's the suggestion?
So instead of just laying those two things out as equal facts, maybe treat the LBMA's non-zero-sum view more like a strategic counter-argument, something that needs exploring. Like, why are Citi and Morgan Stanley making this huge investment if they're not actually trying to take a slice out of JP Morgan's pie directly?
Interesting angle. Go on.
Well, for example, rather than just nodding along with the LBMA, you could pivot the analysis. Focus maybe less on total volume growing and more on market share within lucrative segments or, profitability.
Right.
So, okay, the whole pie gets bigger, fine. But maybe the real fight isn't for the whole pie, but for the tastiest slice.
And that slice would be?
The material already points this out. JP Morgan handles the lion's share of the ETF gold custody. That's sticky business, recurring revenue. Super valuable.
Okay, so you're saying maybe the overall market grows, yeah, but the real competition, the friction point, is JP Morgan's hold on that specific profitable ETF custody business. That's what the challengers are truly after.
Exactly. That puts the bite back into the competition, doesn't it? It makes the fight tangible again.
Yeah, it does.
So the actionable thing here is to maybe refocus the competitive narrative. Center it on the battle for those ETF gold mandates, new ones or maybe even poaching existing ones. By doing that, you make the competition feel high value, specific, and you bring back that narrative tension that the non-zero-sum comment kind of dissolved. That's where the drama really is.
That's a much sharper focus, moving from this general idea of growth to a very specific high-value target. I like that. Okay, speaking of high value, the money side of things. That really caught my eye. The piece rightly notes vaulting fees are up because gold's value shot up 50%. Simple enough. But you also include that critical point, running a vault is a big commitment in terms of investment. Big with a capital B, I imagine. So I'm left wondering, do the economics really stack up just based on those fees?
That's the million-dollar or maybe billion-dollar question, isn't it? And that cost-benefit picture needs to be clearer, more robust. We absolutely need to strengthen the rationale for this huge capital spend by getting into the other benefits, the ones that aren't just about fees, the strategic stuff that comes with clearing status.
Okay, so what's missing now?
Well, the current explanation feels a bit too linear, like spend big money, get bigger storage fees. But for banks like Citi and Morgan Stanley, just collecting storage fees, that often feels like just the entry ticket, table stakes.
Right.
Explaining it just that way undersells the strategic necessity of the move. If vault maintenance is as pricey as Ruth Crowell implies, these massive commitments have to unlock way more value than just rent on gold bars.
Makes sense. So what's the more value?
To really beef up the analysis, we should bring in some context on those secondary benefits, the things that maybe aren't in the press release but are crucial drivers.
Such as?
Clearing status is about vertical integration. It's not just about storage. It gives huge advantages for their internal trading desks, right? Makes hedging strategies way more efficient across the whole firm. And critically, it lets them offer seamless physical metal services directly to their big institutional clients, their high net worth clients. That locks those clients in deeper. It's part of a bigger relationship package.
Ah, okay. So the vault and the clearing status aren't just cost centers hoping to make money on fees. They're actually infrastructure. Plumbing, almost, that enables a whole bunch of other profitable activities. The control over the metal itself is key.
Precisely. It's foundational. So to make that concrete in the piece, you could discuss how clearing status boosts their own proprietary trading profits, or how it improves risk management firm-wide. Those are huge potential revenue streams, totally separate from storage fees.
Got it.
Another angle? Try to estimate the ROI. What do analysts think the return on investment needs to be to justify these costs? Linking that required return back to the potential gains from trading, hedging, and those premium client services reinforces the strategic logic. It makes the investment look less like a punt on fees and more like a necessary foundation for competing at the top level.
That definitely paints a more complete picture. It shifts the focus from just the upfront cost to the long-term strategic value, making the whole thing seem much more calculated and, well, essential for them. Okay, third point. This one really intrigued me. The difference in timing you highlighted between the two banks.
Yes, the pacing.
Yeah.
The material explicitly says Citi's process for their UK company and clearing is well developed. They're quite far along, but Morgan Stanley, their plans are at an earlier stage. Why the gap? These are both giants. Why aren't they moving in lockstep?
That difference in timing, that's not just a detail. It's potentially a goldmine for strategic insight. We really should leverage that explicit contrast to get a sharper understanding of the hurdles involved, maybe first-mover advantages, that kind of thing.
Okay, how do we dig into that?
Well, the weakness right now is that the piece mostly groups Citi and Morgan Stanley together. They are the challengers, which is true, they are. But lumping them together like that kind of glosses over the strategic implications of why they're on different timelines.
Right. It treats them as interchangeable challengers.
Exactly. Are they hitting the same roadblocks? Is Morgan Stanley maybe stuck on some regulatory piece that Citi sailed through? Or maybe Citi just started earlier? We don't really explore the why behind the timing difference.
So the suggestion is,
Focus the analysis specifically on the implications of Citi potentially being the first new clearing member in London in ages. What does that mean? What specific hurdles, regulatory or maybe logistical, might Morgan Stanley still be facing? And conversely, what does Morgan Stanley gain by being slower? Do they get to watch Citi, maybe learn from any mistakes, perhaps wait for better technology to become available? Analyzing this difference gives much deeper insight into what it actually takes to break into this exclusive club.
That's a really smart way to use that detail. Use the timeline difference almost like a diagnostic tool. So Citi's moving fast, maybe, linking back to our earlier point, they're rushing to grab those ETF custody clients. Perhaps they already had some infrastructure in place that made it easier.
Absolutely plausible. You could analyze that. Did Citi already have, say, the right kind of UK banking license, or maybe existing regulatory relationships that smooth the path? And contrast that with Morgan Stanley. Maybe they face bigger hurdles, like finding and securing suitable, high-security physical property in London. That's not easy or cheap. Or maybe they need specific tech integrations or licenses that Citi, for whatever reason, found easier to manage.
right.
By really digging into why the timelines differ, you move beyond just saying who is doing what and get into why are they doing it at different strategic speeds. That leads to much richer hypotheses about what specific part of the market each bank might be prioritizing. Maybe Morgan Stanley's playing a longer game, building something more integrated that just takes more time.
Using that time difference to illuminate the specific challenges and strategies, that turns a simple observation into a source of real strategic insight. That definitely elevates the analysis. Okay, excellent points. So just to quickly recap, the main opportunities here for refining the piece. You've got a really compelling story, high stakes, lots of moving parts. These tweaks should just sharpen the impact.
Sounds good?
First, that narrative tension. We suggested using the LBMA's non-zero-sum comment, not just as a fact, but as a point to probe deeper. Force the analysis to define where the real competition lies likely, that lucrative ETF custody business that JPMorgan currently dominates.
Yep, sharpen the conflict. Second, we talked about bolstering the why. Deepen the financial rationale for these huge investments. Go beyond just storage fees. Detail those crucial strategic benefits of clearing status, the boost to prop trading, better hedging, locking in those high-value clients. Justify the big bucks.
Makes the whole strategy much clearer. And finally, number 3, really leverage that difference in timing between Citi and Morgan Stanley. Don't just mention it, analyze it. Use their different cases to explore the specific hurdles, any first-mover advantages for Citi, potential benefits of going slower for Morgan Stanley, and what it tells us about their individual strategic priorities.
Exactly. Those refinements should make the analysis even more insightful, strategically sharp, while keeping that great narrative drive you started with. We're definitely looking forward to seeing the next version once you've had a chance to work through these ideas. Please do send the updated material back for another look.